Dividends are cash in the hand, and this graph is one of the reasons why you should consider dividend investing. In this video, I'm going to teach you why it's important and show you how to do it. What's up guys, my name's Thommo, and I'm on the journey to build my share portfolio up to 100k, one financial tip at a time. And I'm glad you're coming on that journey with me. And keep in mind, I'm not a licensed financial advisor, so this video is more educational in nature. Let's first talk about what dividends are and how you make money off stocks. So you make money off stocks in two ways. The first is that the stock increases in value. Say you buy it for $100, the stock goes up in price, up to $110. That is called capital appreciation, or the growth in the stock. Now, the benefit of the stock increasing in price is that you don't get taxed on that amount. You only get taxed when you actually sell the stock. That's really good. Paying tax later is always better than paying tax now. That's the first way you can make money on stocks. The second way you can make money on stocks is that some companies elect to pay what's called a dividend. Not all companies pay dividends. Normally the bigger companies do. And the dividend is profits that the company has made during that year, and it passes on that profits to shareholders. That's what a dividend is. And you receive that as cash in the hand. Now, the downside for that is you must pay tax on the dividend you received because you're actually receiving the cash in that situation. So those are the two ways you make money on stocks. Now, in order to grow wealth, in order to build a big portfolio of shares, you want that machine to compound and grow bigger each year and every time. That's really the key goal, is to make that money compound and compound and compound until you get a big enough pot. The dividend though, because you're getting taxed on that amount, you get a little bit less. So that does impact a little bit the ability to compound. The flip side of that is what I'm going to talk about right now. In the world of investing, one of the first goals that you might consider is getting to $100,000 share portfolio. And the reason for that is because it's really, really hard. It's really, really difficult to do. It takes a long period of time. Charlie Munger has a great quote in this: you've got to get to your first $100,000. Now, the graph that I showed you at the start demonstrates that it's a long time and it's very slow to get to this first $100,000. After that point, however, it becomes shorter and shorter and shorter to grow your share portfolio. It starts to go up exponentially, and this is where dividend investing comes in. I think can be important, especially for beginner investors. When you're in that start off phase and you don't have much cash, you're struggling to get cash to grow and buy more shares. That's when it can be really, really important to perhaps focus on dividends. That's what I do. Some of the companies I buy are higher dividend paying companies, and that is purely to build up my asset base to start with, build that compounding machine. All the dividends I receive, obviously I pay tax on them, and then I'll reinvest them into more shares. So having a dividend focus can help you with that cash shortfall, or that struggling to get cash, especially when you're a beginner investor. It helps with reaching that $100,000 a little bit quicker because you're receiving cash in the hand as opposed to just investing in companies that are going to appreciate in value. And as you become a more sophisticated investor and cash becomes less of an issue for you, then you can start to consider companies that are going to have both of those things we discussed at the start. They're going to appreciate in value, they're going to go up in price, they're going to become better companies, as well as pay a small dividend. So what actually is a good dividend? It's important to understand the concept dividend yield. That's a common concept used in investing circles. And what that basically means is the dividend that company would pay during the year divided by the share price. So as an example, if you bought a company for $100 and it paid a $3.75 dividend, the dividend yield is 3.75%. Now, in the Australian stock market, the average dividend yield is around that. It's around 3.75%. Higher dividend yield companies are companies that pay up around 5 and 6%. That would be considered to be a higher dividend yield paying company. Now, one of the downsides to dividend investing is that sometimes high dividend paying companies don't actually appreciate much in value, don't actually go up in price very much because they're paying out a lot, if not all of their profits every year. It leaves little money for them to reinvest and grow. That's one of the downsides. But in terms of finding high dividend yield paying companies, it's fairly simple. You can just Google it. Now, there are lots of ETFs, which are exchange traded funds that focus on high dividend yield paying companies. Now, I'm not making any financial recommendation to buy any of these, but we'll take a look at a couple. So the first one is offered by Vanguard, and it's the Vanguard Australian Shares High Yield ETF. Talking about high yields, this one has an approximate 5.5% dividend yield. Another option is the Beta Shares Top 20 Equity Yield Maximizer Fund, and this dividend yield is 7.59%. Now it's important to remember these yields will change and they will vary a little bit year to year. They really depend on the two things we discussed earlier: what the share price is at the time in which you buy in and what the dividend is paying. If the dividend remains constant each and every year, but the share price keeps going up and up and up and up, it means the dividend yield gets smaller. You have a higher share price with a consistent dividend yield. The absolute best outcome is an increasing dividend and a decreasing share price, but that's quite rare. So that's really important to remember. These dividend yields will change each year. They will vary slightly. These kind of ETFs focus, however, on high dividend yield paying companies. So another option is the Global X S&P ASX 200 High Dividend ETF. That's got an approximate 5.5% dividend yield. iShares has an option as well, 5.3% dividend yield. So you can see most of these ETFs pay around the 5% range. That's considered to be a high dividend yield. I'll leave a link in the description of some websites that I found so you can do your own research and decide which is the best ETF for you if you want to decide to do some dividend investing. So to sum up, dividend investing can be really helpful for beginner investors because it can help you with cash flow to help you grow your portfolio, grow your asset base. The bigger the asset base that you have, the more dividends you'll get paid, and then it compounds and compounds and compounds. So it can be really helpful for beginner investors. As you start to become a little bit more sophisticated, it's probably then better to look at the underlying metrics of companies. You want companies that are going to increase and grow in value over time, as well as possibly pay you a dividend. You really want to buy high value companies. And this is what I do. I have a portion of my portfolio that are paying dividend, high dividend yield paying companies. I then use that cash, use those dividends to reinvest and grow my stock portfolio. And as I'll be getting more sophisticated, I'm now looking at more companies that are higher quality companies that increase in price and increase in value. Hope that was helpful. I'm on the journey to a 100K share portfolio. Want you to come on that journey with me. Go and check out my channel if you like this sort of content. I've got all sorts of finance tips, help to save money. We can put into your share portfolio. And I'll see you guys in the next video.